All right, aspirants, listen up. If there's one topic you absolutely cannot ignore for your exams, it's the RBI's take on stablecoins. It's a huge deal, and we're about to break down a key policy speech so you can walk away with a crystal clear understanding that'll give you a real edge.
So here's our game plan. We're going to start with the absolute basics. What's the difference between money and crypto? Then we'll get into what stablecoins are all about, weigh their supposed benefits against the very real risks, and finally, look at India's strategy. Think of it as our roadmap. Let's dive right in.
Okay, first things first. To really wrap our heads around this whole stablecoin thing, we've got to go back to basics. What exactly is money in the modern world? And how is it fundamentally different from something like Bitcoin? Getting this distinction right is the key to unlocking the entire topic.
Now, for your exams, you got to remember these three words: value, fiat, and single. Fiat just means the government says it's money, and that's that. It's backed by sovereign authority. And single? Well, that just means a rupee in your wallet is the exact same as a rupee in your friend's bank account. They're all perfectly interchangeable. Makes sense, right?
And boom, this is where you see the huge divide. On one hand, you've got our good old sovereign-backed money. Rock solid. On the other, you've got crypto. And as you can see, it doesn't measure up. There's no one promising to pay you back, its value is purely speculative, and it's on a wild roller coaster of volatility. We're talking about two completely different universes here.
All right, so if Bitcoin and other cryptos are just too unpredictable, what's the supposed fix? Well, that's where stablecoins enter the chat. The whole idea is to peg their value to something stable, like the US dollar, to calm things down. But, and this is the big but, does that actually turn them into real money?
And that right there is the million-dollar question. It's what keeps policymakers up at night, and you can bet it's exactly the kind of critical thinking point that could show up on your exam.
You know, when you first read that definition, it sounds pretty good, right? They're backed by actual assets, so they should be stable. But when the RBI dug in, they found a couple of massive cracks in that foundation, hiding just below the surface.
So here's the kicker. The bottom line is this: even with all those reserves, it's not sovereign money. There's no rock-solid legal guarantee you'll get your one-to-one value back. And even worse, you'd end up in this messy world where different private companies issue their own competing money. History has shown us, again and again, that's a one-way ticket to chaos.
Okay, but let's play devil's advocate for a second. What about the supposed upsides? Let's really put the arguments for stablecoins to the test, especially when we look at them from an Indian perspective. The people who are really pushing for stablecoins usually bring up these three big points. They say it'll make sending money across borders way faster and cheaper. They claim it'll help with financial inclusion. And they pitch it as this essential bridge, connecting the Wild West of crypto to the regular, real-world economy. But here's the knockout punch from the RBI's perspective, and this is a golden nugget for your exam answers. For pretty much every problem stablecoins claim to solve, India already has a better, homegrown solution. I'm talking about UPI. It's cheap, it's instant, it's public, and it's already expanding globally. So the real question is, why would we need a risky private alternative when our own system is already world-class? Okay, now we're getting to the absolute core of the RBI's concerns, the big, flashing warning signs. We're talking about the huge risks these things pose to our entire financial system.
Now, take a look at this quote. At first, it sounds completely backward, right? The biggest threat is a stablecoin that works well. But think about it for a second. It's a brilliant paradox. What the RBI is saying is that the more popular and successful a stablecoin gets, the more it eats away at our own currency, the rupee. Its success is the danger.
And we're not talking about small risks here. This list is a goldmine for your exam. This isn't just about some traders losing money. We're talking about fundamental threats to our economic sovereignty. The central bank could lose its grip on monetary policy. Banks could be starved of deposits and stop lending. Our whole economy could become vulnerable to shocks from who knows where. Every single one of these points is a massive red flag.
Okay, let's zoom in on this word for a sec. Seigniorage. It sounds complicated, but it's really not. Just think of it as the profit the government makes from issuing money. You know, the difference between the face value of a 100-rupee note and the few rupees it costs to actually make it. That profit belongs to the public. It funds our schools and roads. The danger with stablecoins is that this public revenue gets siphoned off and handed over to private, often foreign, companies. That's a huge deal.
So,
Faced with this mountain of risk, what's India's move? Well, it's not to just say no to everything. It's to lead with our own innovation. And the answer to that is the CBDC, the central bank digital currency.
And this comparison just says it all, doesn't it? A stablecoin is private money with ambiguous promises. But a CBDC, that's the e-rupee. It's a direct promise from the RBI itself, backed by the full faith of the nation. It passes every single test for what money should be. From the RBI's perspective, this is how you get innovation without the chaos.
And you've got to understand, this isn't just a reaction. It's a very deliberate, proactive strategy, and it's built on these 4 pillars. The goal isn't to block technology. It's to steer it, to make sure that any innovation actually strengthens our financial system instead of trying to build some risky parallel system right next to it.
Okay, we've covered a ton of ground, so let's boil it all down to the absolute essentials you need to walk away with. And stick with me, because I'm going to give you a super simple trick to remember all of this for your exam.
Okay, if you remember nothing else, remember these 4 things. 1. Stablecoins just aren't money in the true sense. 2. Their so-called benefits, we're already doing it better with UPI. 3. The risks they bring are massive to our sovereignty, our economy, everything. And 4. India's official path forward is our own CBDC. That's the whole argument right there.
And now for that memory hack I promised you. To lock all of these arguments in your head so you can pull them out under exam pressure, all you have to do is remember the word stablecoin. Seriously, take a screenshot of this, write it down. This table is your secret weapon. Each letter in stablecoin is a prompt for a key argument. S for sovereignty risk, T for trust deficit, A for the alternative, which is the CBDC, and so on. It covers everything we've talked about perfectly.
And really, this final quote just wraps it all up in a neat bow. The official viewpoint is crystal clear. Why on earth would we take on all these huge systemic risks from private currencies when we can achieve the very same goals, but better and safer, with our own sovereign digital currency?
And that really is the big question going forward, isn't it? This is the battle that's going to define the next chapter in the story of money, sovereign innovation versus private alternatives. It's a debate you'll definitely want to keep watching. I really hope this deep dive helps you nail this topic. All the best with your preparation.